Apple or Microsoft? Which one is a better stock to buy? Both companies are in the information technology sector and have had tremendous 10-year return. They also both have very diverse revenue streams. So in this video, we want to review the two companies, assess their revenue segments, go over the latest quarterly earnings, and look into a couple of key financial metrics that allows us to decide which company is a better buy. And in the end, of course, I will share with you which company I will be considering to buy at this time. Looking at the profile of these companies, both of them are in the information technology sector and have somewhat of a similar market cap, well in excess of $1.3 trillion. If we dive a little bit deeper and take a look at Microsoft's latest quarterly earnings, we see that their revenue is somewhat more diverse in three categories. The first category is productivity and business processes, where they show $11.7 billion in revenue, including 21% increase in their LinkedIn revenue. Second stream of revenue for Microsoft is in their intelligent cloud. Here they've seen an increase in their server products and cloud services, thanks to Azure cloud services that they offer. For those of you who may not be familiar, Azure is a comprehensive set of cloud services that offers developers, IT professionals, and enterprises the freedom to build, deploy, and manage applications on any platform or device. The infographic on the right side is based on their 2018 annual report and is there to illustrate how they have evolved their revenue streams over time. Moving on and looking at Apple's quarterly earnings. Their latest quarterly earning was Q2 of 2020, where they show a 50% revenue earned through their iPhone sales. This is followed by 23% revenue from their services, 11% from wearable, home and accessories, 9% from Mac products, and 7% from iPad. The infographic on the right was from 2018 annual report. Previously, they had almost 63% of the revenue coming from iPhone, whereas now it's only at 50%. Looking at the valuation of these two companies head to head, we noticed that in terms of the price to earnings ratio, both for trailing 12 months and forward PE, Apple is sitting at a better spot. In fact, its PE ratio is better than the sector median. Whereas for Microsoft, these numbers are way closer to the sector median. As for price to sales ratio, both Apple and Microsoft are doing poorer than the sector median. Yet, for Apple, this ratio is a little bit more modest. Looking at the price to book ratio, which compares an enterprise's market capitalization to its book value, we notice that for Apple, this number is very high. In fact, for the trailing 12 months, it's sitting at 17.58, whereas for Microsoft, it's lower, sitting at 12.16. Nonetheless, both of these figures are way higher than the sector median, which may suggest that these companies are a little bit overvalued at this time. As for price to cash flow, Apple has a better ratio, here sitting at 18.34 for trailing 12 months, which is somewhat closer to the sector median. For Microsoft, this number is sitting at 23.95. All in all, looking at the valuation, it is fair to say that these companies are somewhat overvalued when compared to the sector median. Moving on and looking at the revenue for the two companies and how it has grown over years, we notice that Apple's revenue is way higher than Microsoft. In fact, it's almost double the revenue that a Microsoft company has. But it's not just the only factor that we have to take a look at. In fact, personally, I'm more interested in the revenue growth and comparing it to the previous years. Looking at Apple, their trailing 12 months revenue growth is showing 3.67%. But what excites me about Microsoft is their amazing 13.49% growth in their trailing 12 months revenue. This is followed by several amazing past years' growth as well. Microsoft showed a 14% plus revenue growth both in 2018 and 2019. As for net income and net income growth, Microsoft is again the lead here. Their June 2019 annual report shows a whopping 136% plus growth in their net income, and their trailing 12 months is also showing 32.47% growth. Whereas for Apple, these numbers are a lot more humble. September 2019 annual report showed a decline in net income, and their trailing 12 months is barely positive. Next, we're going to take a look at a number of head-to-head charts from macro trends to illustrate where these companies sit. Looking at the price to earnings historical values by quarter, Microsoft is currently showing a higher price to earnings. So keep in mind that for a price to earnings, we ideally want to see a lower amount than the sector average, and in Microsoft's case, the P ratio in fact is quite high at this time. And in fact, historically, you could see how this number is way higher than the past quarters shown on this graph. As for Apple, looking at the Q1 2020, still this P ratio by quarter is somewhat higher than their past several years. The cash on hand graph is the next one that we're gonna take a look at. These figures are shown in $billion, and you notice how as these companies grow in terms of their market capitalization, so does their cash on hand, which allows them the flexibility to navigate through difficult times. At this time, Microsoft has much higher cash on hand compared to Apple. Looking at their current ratio, which measures their ability to pay short-term obligations or those that are due within 1 year, we notice Apple is sitting at 1.5, whereas Microsoft has a current ratio of 3. Usually for current ratio, any number above 1 is acceptable, but for Microsoft, of course, sitting at 3, this is a much better spot to be at. Let's take a look at operating margin, which measures how much profit the company makes on $1 of sales after paying for the variable costs of production, such as wages and raw materials, but before paying any interest or tax. As for Microsoft, it's currently sitting at a better spot, showing close to 37% for its operating margin, whereas for Apple, it's sitting close to 25%. Return on equity is the next graph that we're gonna dive into, which is calculated by dividing the net income by shareholders' equity. And because shareholders' equity is equal to a company's assets minus its debt, the return on equity is considered the return on net assets. And of course, if you have a higher number here, it's more acceptable and present. As for Apple, this is way higher, sitting close to 65%, whereas for Microsoft, it's sitting just under 44%. Looking at the price momentum for the stocks of these companies, they're both showing very positive trends, which is also reflected in their stock returns. Looking at the Apple stock and their 1-year return, it's showing a whopping 76.55%, whereas for Microsoft, it shows a 45.51%. That said, Microsoft has a better year-to-date return, currently sitting at close to 17%. In fact, among the Dow Jones companies, which consists of the 30 large companies in the US, Microsoft is sitting on top of the chart with the best year-to-date performance. We recently posted another video going through the performance of the Dow Jones stocks, which might be of your interest, so I'll put the link in the description down below. Let's also take a look at their dividend payments. This might be particularly interesting for the dividend investors. Both companies pay a relatively low dividend yield at this time, sitting close to 1%, but keep in mind, both Microsoft and Apple are considered as growth stocks. So usually for a growth stock, the fact that they are still paying a dividend, even if it's low, is considered a very good positive, because you're getting the best of both worlds. The companies are aggressive in terms of their plan to grow, but at the same time, they're paying you some modest dividend on the side. Apple has grown its dividend for the past 7 years straight, whereas Microsoft has grown its dividend for the past 16 years. They're also sitting at a very reasonable payout ratio. Apple closer to 27% and Microsoft closer to 36%, which is quite reasonable. In fact, when I'm looking at a payout ratio, any number under 60% is considered acceptable for me. As we talked so far, both companies are amazing companies to invest in and not look at as a trade, but rather as a long-term investments. That said, based on my evaluation so far, I like to think that both companies are currently overvalued. And in fact, they are priced at very close to their 52-week highs. So I wanted to take a look at the price target for these companies according to analysts. The 1-year price target for Apple sits at 308.91 at this time, which is in fact lower than their current price. And for Microsoft, it is sitting at $193.94, which is slightly higher than their current trading price. That being said, here's how I approach these companies when it comes to investing in them. I currently have shares of Apple, and I intend to keep them for the longest, but I do not own any shares of Microsoft. That said, it's not a surprise that I would love to buy the shares of Microsoft and add to my existing shares of Apple in my portfolio, but I don't think this is now the time. In fact, I've added both these companies to my watch list. I'm watching them like a hawk, and I'm looking for some reasonable pullbacks before I pull the trigger and buy the stocks of these companies. For Microsoft, I'm a lot more comfortable with a stock price of 165 or under, and for Apple, I'm hoping to be able to buy it lower than my current average price, which is sitting at 282. So definitely I will be keeping an eye on these two stocks. Let me know in the comment section below. Do you own shares of Apple or Microsoft? Which one do you think is a better buy? I hope this video was of value to you. I put a lot of efforts to prepare this, so I really appreciate it if you can hit the like button and support this channel. If you would like to see more videos like this in stock market investing and financial freedom, please be sure to subscribe to Moementum channel. Here on Moementum channel, we post weekly videos about stock market investing, finances, and personal development. Hope to see you next time.